Hi, everyone. It's great to be here again in this webinar where we're going to talk about the 5 modeling mistakes and how to spot them. And I think these days, in time of AI, it's more important than ever to understand where those mistakes are because these are things that you need to pick up in case you are looking at models that were AI created. So I think it is a great topic for today. So I'm gonna start here sharing my screen with you and gonna share screen and let's start. Okay, so floating control. So let me just clean here so then it's easier for me to see and talk to you about the 5 modeling mistakes we see most often and how to fix them. We are from Cambridge Finance. So in this 30-minute webinar, we'll cover how do you define mistakes in financial modeling, what these mistakes are and how to spot them, and also how to fix them. Okay, so if you are new here, my name is Maria Widner. I'm a CFA charter holder. I'm also a charter surveyor. I'm the founder and trainer at Cambridge Finance, and we are a specialist real estate finance and financial modeling training consultancy firm. And I'm also founder and CEO of Real Estate Women, which is a diversity networking group. And I'm also part of the RSS Commercial Property PGP, so the professional group panel. And I'm associate professor at iUniversity. And I also have published a book about real estate financial modeling in Excel, and it's being published by Routledge and Taylor Francis. Um, so let's start with the 5 common modeling mistakes, the overview. So I think we can put them in 5 different boxes. One is the conceptual errors. The second one is the calculation errors. And the third one, not following best practices. Fourth is the flawed data. And then fifth is inadequate sensitivity and scenario analysis. Okay. And then so it's more than 5 mistakes. It's five uh, modeling error groups, I would say. So in terms of conceptual errors, is pretty much the when you don't know really um, what you're doing and you're just looking at a spreadsheet and then you have a deal, for example, and then you want to model it out and then you can start from these days Claude, ChatGPT, just asking them for a model and then it comes out and then you need to check it. So here my example of the conception errors is one that I see the most is also like somebody has done a model already, and then you are using this model for everything that you see. So one thing I see is like, okay, there's an office model or one that you have downloaded from the internet. And you don't understand really what the model is doing, and then you try to put your your deal into this model, and they don't really fit. So you're trying to feed your deal into a model that it's not really um, fit for purpose for that deal. So if you have an office, for example, model, and then you want to model a shopping center, a hotel, or retail asset, and then this model is for an investment and the one that is already with a tenant in there, and then you want to do like a kind of value add model, or you want to do a development model, and then you just want to try um, to to make this model work for the specific deal you have. I'm not saying here that you have to start your models every time from scratch, but having specific models for each cases will help you a lot and really understanding the business case. So that's the concept. So do you understand the concept? Another example that I have here is these are the theoretical errors as well. So you need to be very aware of the the theory of real estate finance, so then you don't make those mistakes. So for example, here treating the purchase price as equity rather than total cost, ignoring stamp duty, acquisition fees in the capital stack, for example. Or for example, if you're going to calculate what is the equity required, but then there are some if there are some like negative cash flows down the line because you're going to have vacancy, you're going to have some capex that is going to be needed at some point in time. But then you just raise the equity, just want to raise the equity based on the purchase price, then it will be a mistake. You're going to have a problem with that going forward because you're not going to raise enough money for this deal. So it's very important for you to understand what is the I would say the theory actually of calculating equity, for example. That's just one example. Another example here of conceptual error is on the theoretical side as well, is a lot of people put the GDV as your revenue, but then you have to be a little bit more granular in that calculation. So you need to understand, if it is the GDV is not the sale price. So you need to go through like the calculation of the transaction costs, and you need to figure out how much is going to be the agent fee, any VAT treatment as well on how much you sell, what is your assumption on the GDV, and then you have to work out what is the sales proceeds, the net realizable sales proceeds. Uh, then another example here is apply investment yields to net income, but they're using gross passing rent as an input, and then you're going to overstate the asset value. So there's always this confusion. What is the net yield? What is the gross yield? Should the exit value be based on the gross yield, net yield? So you need to be very careful with how you're going to show this in your model, and how you're going to make sure that this is the logic there is correct. Because as much as we know that our model is a forecast and we're not going to be right in our forecast, how you present it and how you explain and your comparables, these are very important when we are going to do the analysis of the investment. So how to fix it, it's one thing that I always say is have a very good theoretical background. So understand, valuation, understand how the costs are going to be distributed in your cash flow, and map the deal structure in plain English, plain Spanish. I am in Madrid today. So mainly put in your head what is the deal first, where the money is going to come in, where the money is going to how is the money going to be used, and then you open Excel. So understanding the business case is very important. So sometimes I even put like in a piece of paper, and then I think about the structure of the deal, so then I can think about the structure of the model. Okay, so the model, as the name says, should actually model what is going to happen in reality. So that's why it's important. So just do a draft model in a piece of paper, and say, okay, this is how I want this to look like, and this is where the money is coming in. That's how the money is going to be going out, and so on and so forth. Define each input explicitly. Is it gross or net? So have the theory very well defined before you even open Excel. So what are the comparables? Do you know the basic the fundamentals of valuation? So this is what you need to transpire in your model. Is it going to be a pre or post-tax model? Draw the cash waterfall by hand first. So really think about the model, and really have a very good understanding of the 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 theory, the technicality of the model before you even open it. So the model here should formalize the logic that you understand first, and the model is not for you to discover afterwards. Oh, is it going to be then you have to figure out, oh, how do I calculate the GDV? Oh, now I have to calculate the GDV. Oh, now I have to calculate the construction cost. Am I going to split? How do I split the construction cost? Is it going to be a straight line? Is it going to be an S curve? Is it going to be the waterfall? Do we have a promote structure? We don't have a promote structure. What are the hurdle rates, and so on and so forth. So these are important assumptions that you need to have very clear before you even open Excel, so you don't get to those conceptual errors. Then the second error group is the calculation error. So these are mainly like formula errors. Okay, so one of the formula errors that I see the most is hard coding figures in Excel. And this is a one source, the main source of mistakes in models is that you have hard coding numbers. So what does hard coding mean? Put a number within a formula. So if your interest rate is, say, 5%, and then you put 5% in the model of interest calculation instead of having this as an input somewhere else. And this is one area that you have to be very careful using AI, because AI really likes to hard code numbers. So you need to really open the Excel that AI generates and see, I want actually a flexible cash flow, a flexible model. Otherwise, the AI will have a lot of hard coding numbers. Formula linking to the wrong input. So by the example here, for example, you have a cell named interest rate. You have named the cell their interest rate, but it doesn't actually relate to the interest rate. So that input is actually a fee assumption. But because interest rate, the name of the cell is not explicit in the name of the cell as such, you have to be very careful that the name, it looks there in the cell, interest rates times your opening balance of your loan, even though it looks like it is interest rate, but it's linking to a cell that the input refers to something else. This is going to be wrong. Okay, and this can also be not only to named cells, it can be to anything else. You just put there D5, but then the D5 is not related to the interest rate input, is related to LTV input or something else. And then it means that all the calculations are going to be wrong. Okay, so you need to be careful with where you are linking. IR versus XIRR, NPV versus XNPV is also another error. So sometimes people forget that the IRR is based on the should be used only when you have like annual cash flow. If you don't have annual cash flow, then you need to compound this rate. And then also you need to calculate the NPV. And then sometimes people forget the NPV is considering cash flows in arrears. So you need to exclude the period 0. And people say, well, then why use NPV and IR when I can use IXIR and XNPV all the time? It is true. It's just that sometimes the XNPV and XIR don't work when you don't have cash flows in the first period. So then you're gonna get an error, and then you have to revert to IRR and NPV formulas. So how to fix it? You have to audit the formulas independently of output. So you need to trace dependence. Normally what I see is that if things don't look right? So then with the experience, you're going to open a spreadsheet and say, well, these rents look too high or too low. I'm expecting vacancy to come in here, but then there's no vacancy here. So all this is it's very important for you to check. So run a cross check. Sum and test boundaries conditions such as 0 rent or 100% vacancy. So do really stress tests. And because my take is that if you don't understand when a number breaks, you don't understand the calculation. So, and if you're seeing like errors like div 0. So it's the error that is the division by 0. So where is this error coming from? So do you understand that there is going to be an error when you stress test it? So if you understand that when it's going to break the model, then that's when you say, okay, this is the assumption. You should not the yield should not be 0, or the vacancy cannot be less than 1 year or something. You have to make those assumptions, so then you understand when the downfalls of your model, and then you can say explicitly say, okay, these are the assumptions, and because otherwise people are gonna put wrong number. You may put wrong number that don't really reflect in the calculations of your model. Okay. Um, Not following best practices is also a very important error. So, for example, example A, it's the hard coding situation. So the best practice is a way for us to avoid errors. Okay, so I would always follow best practice in order to avoid any errors, because if you follow best practice, then you're going to get a more robust model. So the first rule of best practice is never hard code. So maybe you're going to see the formulas that was hard coded, and then it's going to lead to mistakes. Example 2 is if you have no color coding, and then the color coding is not, it makes your model look not as friendly, because you don't know what you can change, what you cannot change, and then you have to be the inputs that will really affect your calculations are not clearly checked, or clearly not appearing clearly in your model. So that might be a problem as well. And then the other thing is, this is not really an error as such, but it's an error because you don't follow best practice. Is if you have like too many functions. If you have, for example, the formulas there, even if without a functions, but the formulas they are like 5 lines long. This is a mistake, and again, you have to be careful, because AI sometimes love to put like very long formulas, and this is not the most elegant, so you should not do this. How to fix it? So it's a matter of making your model look elegant and follow best practice. So you always separate your inputs, your calculations, your outputs in distinct areas. Should they be different tabs? Well, that depends on how you like to model. Sometimes I use different tabs, sometimes I use the same tabs, especially if it's input and output together, because then if I change an input, then the output will show immediately, and then I can check, okay, does it look right to me? Is the model being calculated correctly? So a model should be self-documenting for a competent third-party viewer. So you need to be very clear when you are doing this model, that if anybody is going to look at your model, then they will understand where the inputs are, where the outputs are, and everything is color coded according to the inputs and outputs as well. Your formulas are elegant, no, not large formulas, and this is how you see that the model is robust, the model was thought through and everything. Then the next mistake is poor assumptions in inputs. So that's pretty much the idea of garbage in and garbage out. So if you say a rental growth assumption of 5% per year, so this is just to say, like, even though your model looks right, but your inputs are rubbish, so it's going to be rubbish in, rubbish out. And this is really the idea of understanding the asset well, understanding the market well, understanding the theory, the real estate finance theory. It's all very important when you're doing the model. Example B, it's if you're just gonna say, okay, I'm going to use a yield for the exit value for the development, but then you're gonna say, okay, this is my GDV. Okay, you calculated the sales proceeds, but you don't take into consideration the lease up, how long it's going to take you um, to achieve full um, full completion, or how you can, or full occupation, or is full occupation stabilized occupation, or you think is going to be 80%. So all this important assumptions are need to be checked. So sometimes I understand the inputs is a matter of opinion most of the time, but you have to have very robust opinion as well. Otherwise, it becomes like the garbage in, garbage out situation. Um, Example C here, void periods and letting fees absent from the cash flow because the base case assumes immediate full occupancy. So yeah, this is a mistake. It's sometimes you just want to be overly optimistic. You're going to achieve full occupancy once you open the shopping center, for example, but that's not the case. Um, so understanding the economics of real estate are very important when you're doing the model. How to fix it. So source every key assumption from comparable market transactions, understand what the market is telling you, and then also filtering what other people told you, what AI told you, what your research told you. Like try to make your assumptions that are robust given your knowledge of the market. Um, if you cannot defend an input in front of an investment committee or lender, it should not be in the model. So your assumption log is part of the deliverable. So always put like the comps there, the rental comps, the yield comps, and say, well, this is important for when we are doing the underwriting, analyzing the investment. And then last but not least, so when we're doing sensitivity and scenario analysis, we have to put there, and then I've seen so many sensitivity analysis. So sometimes people like to go a little bit overboard on the data tables. So you have to be, very robust in how you do the risk assessment in your model. So number one is an example here, no downside scenario modeled. A lender or investor has no way to assess where the deal breaks. So you need to be realistic there and say, okay, this is the downside. This is, in case instead of achieving full occupancy in 1 year, you're going to achieve full occupancy in 3 years. So in 3 years, will this deal break? Like what's going to happen? Or inflation, cost inflation, if it's too high, and so on and so forth. Um, Irrelevant variables tested. So this is what I meant in the beginning, lots of tables that just make your model bigger and bigger and slower, and it doesn't tell you anything, and it just makes you very, very confused. So you need to be careful what kind of sensitivity tables you're going to put, which inputs you're going to stress test, which inputs are important. And people love the two-way data tables as well, but sometimes this two-way data table, the variables that you are correlating, they are not really correlated. So then you have to think a little bit more about which inputs are going to put together. Or sometimes they might have also like an inverse correlation, like with rental growth and in the yields, for example. So even though it says, everything going up will give you, uh, you need to be able to understand what the numbers are telling you in this sensitivity table. And then false stress tests is scenarios labeled bear, baseball, but not all three produce but all three produce a positive equity multiple, like positive. By positive, I mean it is you know greater than 1.5, for example. But what we need to know is, okay, so when will this model breaks, like not break physically, but when is the deal not when you're gonna lose your equity? I think that's the question. Like when you're gonna lose the equity, in which scenarios you're gonna lose the equity, how likely it is that this scenario might happen. Okay, because maybe you just need a little bit of change and then the whole deal falls through. And then how to fix it. So we need to identify 2 or 3 variables the return is most sensitive to. So typically it's going to be the exit yield, your rent, cost of a run, for example, and build two-way sensitivity table around them, or just one-way sensitivity table, just so you can see really like, okay, what is the impact of this, of being delayed 1 quarter, one year, what's going to happen to your returns? What happens if instead of achieving rental growth of 3% per year, you're going to receive there's going to be zero rental growth, for example? What happens if you're going to have um, inflation? Inflation is going to increase your interest rates, it's going to increase your yields, the values are going to go down. What's the impact on your returns? Inflation is one area that is really getting to us these days, and we need to stress test it. Include at least one scenario where the deal does not work, because that's when you're going to lose your equity, for example, or if you're a lender, you're not going to receive your money back. So make sure that you are aware of this scenario. Because normally when we are going to discuss deals, this is what people look at when it doesn't work anymore. Okay, so in summary, 5 modeling mistakes and how to fix them. So conceptual errors. So it's mainly like the structure of the model is not correct. So therefore, you need to be very careful. You need to understand the economics. You need to understand if you're going to borrow or not borrow, if there's going to be a JV partnership, if it's going to be just equity, 100% equity. You need to define this beforehand. Calculation errors, make sure that you audit the formulas, that you track where the numbers are coming from. Is the input the relevant input for formulas, and so on and so forth. And test extreme boundary conditions. By boundary conditions means like, okay, when the model breaks. Not following best practice. The main thing about best practice is the hard coding, and also the formulas. If they are too big, this is not good. Then the fourth is the poor assumptions. So garbage in, garbage out. So you need to be able to defend, source, and explain all the data that is going to the model. And then the inadequate sensitivity tables, too many sensitivity tables. You're stress testing too many variables, and these variables are not relevant. They don't go together with one another. They don't make sense. So you have to be careful with your sensitivity tables as well. So a model should formalize your logic you already understand, should not discover it. So this is the main topic for today. Here I'm gonna leave my contact details for you. If you received our emails, probably like if you're here, probably you have already my contact details. But do reach out to us. We do have courses, online courses. We have also in-person courses. We have on-demand. We are here to help you with your career. We also have AI courses. So it's all up to you how much you want to learn. We are here in terms of real estate finance. I think we are the best ones in the market, especially in Europe and further east. So I think it's a great pleasure to be here and share my knowledge with you. If you have any questions, please do send them to us, and I hope to see you very soon. Many thanks.